All right, everybody. So I'm gonna go over how to get pullbacks and basically how to trade. All right. So the first thing is, and this is really important because if you get this right, you'll you'll know where the pullback is going to go, and at least be prepared for it in advance. So one of the biggest problems is when people don't know where the pullback is going to be, they're going to they're going to buy this. And because they're going to buy this, it basically screws them over, right? So this is directly tied to entries. What the hell did I do? Anyway, this is directly tied to getting the right entry and getting a low risk entry. And also, this is a skill where I don't know how to explain it, but one of the major problems is like if you ask someone what is a trend, first of all, if you ask someone how are they supposed to trade, they're going to give you the answer with the trend. If you ask them how do you trade with the trend, they're going to give you a vague answer like buy the pullback or buy the dip or something like whether BTD or I don't know, buy the dip. But no one really, or a lot of folks, they don't understand how to buy the dip. And then if you ask someone who knows a little bit more, they basically tell you, the Forex guys will tell you, it's some zone, or the ICT guys will say order block, right? This is what you hear. It's either the zone, the order block, let's get rid of this shit. The zone, the order block, mostly the Forex guys, they will say the zone, order block. The stock guys will say VWAP, and the retracement like 58 or 60, no, 50 or 68. Something like that, like halfway back or 68% retracement. Or what's the other one? Oh yeah, to a moving, moving average, right? I mean, these are the most common ones. What do the futures folks say? I don't really recall what they say, but I don't know. I think generally it's like all of this stuff up here, but it's typically some volume based, or I don't know. It's usually this stuff up here. Okay. All right. Now, so this is what you'll typically hear. All right. So if you ask the Wyckoff folks, you're either gonna hear halfway back, or you're gonna hear Ice Creek, or you're gonna hear wait for a spring or up thrust. This is typical, right? So it's usually one of these answers, but whatever it is, I'll show you exactly what works, in my opinion. That how to think of it. All right. So the first thing is if you ask traders, when they look at a trend, what can they see? They get confused, but they can almost always see the impulses. Why? Because they are green or red. They are green or red, and they can see them. Right? It's the stuff in the middle of those impulses which creates all the problem. And it is so smart. Like, this is how the market gets you. It's this area here. Oh shit, what do I do? All right, it's this area here, which screws over here. That is the problem. The entry and the exit here. This is the problem. It's either that, or if you're buying breakouts, they buy. Well, let's go into that. So the thing is, if you're going to buy a breakout, what is the trade-off? All right. So there are two styles generally. All right. You can trade on the up wave, or you trade on the down wave. When you trade on the up wave, you're typically trading breakouts. All right. Now here's the thing with breakouts. Let's write their pros and their cons. The pros is, I think this is probably the easiest, where basically you draw a line above the high. If it goes above, easiest for entry. All right. The cons are high risk. Easiest entry, but the con is high risk. If it doesn't have follow through, you're screwed, and your stop is going to be pretty far away. Or a lot of times, even if it works, it's going to come back and test the breakout, and you're going to go from profitable to break even, and probably even a little negative, until you go break even again, until you go profitable again. Because you get in on the breakout, it follows through, you make money, but when it tests the breakout, you go back to break even. It might go a little lower than the breakout, you go negative, and then you have to wait, and all of that. All right. Now, if you're buying down wave, this is buying the pullback. The pros, I'll go in a minute. The cons is it's difficult entry. It's difficult. It requires much more skill. Much more skill. Much more skill. And the pros is low risk. It's low risk, but so this is the trade-off of buying on the up wave versus buying on the pullback or the down wave. Up wave breakout is very easy. Anybody can do it. Just draw the line above the high, go in long. Down wave, all of that. And then, folks do to make the breakouts work is they get, stocks that are very strong with relative strength. The breakout has to have high volume, expanded spread. No matter how you do it, you will always have high risk. Why? Because you're buying the high. At that point, the breakout is the high. So those are the highest prices. Relative to the high, the breakout is above the high, so it's the highest price at the time, and then you have to put your stop, and there's going to be a lot of risk. On the pullback, it's low risk, but it's very challenging, difficult entry. It requires much more skill. And, so what usually folks do if they're buying the pullback is they just have like a standard way of buying it. Some will buy halfway back. Some will just buy the moving average, pullback reversion to the mean, like a 50 MA. Or on the daily, they'll use the 20 MA. Or they'll just buy a level, right? You just leave it at that. But with all these techniques of buying pullbacks, chances are you're going to miss it. So, and what I mean by that is you're going to miss it because let's say you're buying these Forex guys want to buy an order block. These guys, they're going to basically have their zone here. What happens? That happens. So they missed the opportunity. So what do they do next? They put a zone here. What can happen next? It may go and they miss it again because it was a spring. So now what do? They put the, over here. And finally, they tap in and it either works or it'll go deeper back in and then it works. Or it stops out. So it works or it doesn't, right? But the thing is, you missed here, and then you finally get it up here. So this typically happens with the Forex, the guys that want to buy the low. And you better know how to time this right, because otherwise you're going to get taken out. All right? So this is the problem. If you're going to buy really cheap all the way back here, it might not go back there. How many times, you're trying to buy the red bar and it doesn't go into the red bar? If it's a 68% retracement and this here is like an 80% retracement, you're not going to get in. And the problem is you're waiting, and it just goes. So it's like it's going to psychologically really wear you out. All right? So the other approach is if you buy halfway back, right? If you buy halfway back, if you're just going to buy halfway back, this is a very easy thing. And if you know how to do this, I guess it's okay. There are times when it's not halfway back. I've seen plenty of times when it's not halfway back. You might go a little bit and, let's say you bought right here. Right? You might draw a little heat. Right? So I can understand the logic of buying halfway back. Chances of it going halfway back are quite high, very high. Normal pullbacks typically go at least halfway back. So I guess this one is all right, but you better make sure that, you have trend and all of that on your side, and because you don't want to get in and then get stopped out. There are situations when that happens, you just have to be ready for it. Like it will do this. If you're buying on the down wave, right? Get stopped out right there, and then it goes up. And they take out these guys, and then it turns trend. Right? So stuff like that happens. So this is like, halfway back approach and all that shit. All right, now we're done with this. I'm going to explain all right, now I'm going to explain how to think about pullbacks and where to catch them. And the thing is, you have to practice this because it's not something you memorize, it's something you apply, and then you get really good at it. And then, believe me when I say, you will be able to forecast where price is going. So by doing this, like, you kind of, how should I say, this isn't an indicator. Your creative, the creative part of your mind, it can figure things out. It starts figuring out trend changes. It starts figuring out where price is going. It starts figuring out where it's going on the target. It starts figuring out, there's like a lot of intuition that's developed if you understand this. So the thing is, you understand the knowledge and you practice, and you start using the creative part of your thought processes. It helps forecast where the pullback is going to pull back to, and then after that the reversal back up. So that part of the mind that's very creative, if that can be engaged, it is really amazing because the purely technical part of the mind, if that was enough for trading, the quants, the indicator folks, anybody who knows a little bit of math, the back testers, all that, they would do really, really well. But that's not, the trading is not rigid. And how you know this is because every single trend in every market, in every time frame, is different one from the other. It's never exactly the same. The fact that it's never exactly the same and that it is not it's not like a like a template, right? Like a precise, means that the market has creative characteristics. It requires creativity to understand it. It's not a 70 is overbought and 30 is oversold. That will never work. All right, that just won't work because the fact that every trend is different means something. Because if it was mechanical or quantitative, it would be 100% rules based, and there would at least be trends, some of them that look exactly the same, but every single trend in every single time frame is different. The size of the various upwaves is different, the size of the various downwaves is different, the time of the various upwaves is different, the time of the various downwaves is different, the volume on the various upwaves is different, and the volume on the various downwaves is always not exactly the same. So, and those three key factors are never exactly the same, especially when they're combined. So what does that mean? That means that it's not a rigid thing. It's not a math thing. All right, it's not like 1 + 1 or like a trend has exactly 5 waves. The idea that the trend has 5 waves is actually contradictory. All right, because it cannot have 5 waves all the time. Although I know it's a common theory, but the market itself is not built off of that understand that it's not built like that. The thing that's being analyzed is not a math thing that it would have 5 waves or 3 waves. And the way you can prove this is just take a look at any trend; they're never the same. And many trends have more than 5 waves. I show, so anyway, I don't want to get into all of that. The point is, what is the point? The point is how to buy pullbacks. So the way you want to think about this, the way you want to think about this is possibilities and sequencing those possibilities. Again, possibilities and sequencing those possibilities. So the first possibility, first of all, you will always be able to clearly see the rallies, right? Nobody should have a problem with determining rallies. Why? It's very easy. They're big waves. Done. Big waves are rallies. They have green, 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 or red, 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 red. Bunch of greens and a bunch of reds. These are the rally waves. They make new highs. They're big, easy to distinguish. The pullbacks, very complicated, but will give you low risk. Now, how to catch that pullback? So step 1 is the lowest area it's going to go. That's possibility 1. So the lowest area it's going to go is around here. This is the zone. All right, this is typically the last red bar or the first green bar, basically also known as the origin of the buying or selling. It's the origin of the buying or selling. It tests the pivot that is the origin of the buying or selling. Why? Because those buyers may still be there and there may be more orders. What happened? Green, 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 green. Comes back. Maybe they want to buy more. Green, green, green. Right? So the origin, that's the first. So that's the last red bar, the first green bar, typically around that area. It's going to come back and test. Okay? That's 1. So when you see a rally, you have that as your first possibility. So we'll just type in scenario 1. All right. This someone said, I don't know what to call it, but it's just basically the origin of the rally comes all the way down. This is a very nice place to buy. Why? Because not only did the buying emanate from there or the selling emanate from the top, but it's also the lowest risk and it's the most reward, because if it goes up, it's the lowest risk, most reward, etc., etc. All right, so we got this done. All right, so you just think of this as scenario 1. Scenario 2 is that market goes and does this retracement and goes. So scenario 2, it goes down into test prior high or low, where support becomes resistance, resistance becomes support, right? Now, this has, in my opinion, it has a higher chance of this is happening if the 50% level is above here. If the 50% halfway back is above the former resistance, then the likelihood of that resistance becoming support, I believe, is increased. All right, so the more of a breakout you have and the more of a rally you have and the follow through you have, the higher likelihood that this resistance will become support and market may not go all the way down to this level. So if you're like one of those Forex guys that are waiting for it to go all the way down here, because that's the only thing that is taught as a pullback area, take a look at how many times does the market pull back into this area when the 50% is above that prior resistance, and backtest that, and you'll see that there's a tendency that the market, when it pulls back down, when it doesn't go down, when it doesn't go to this area, it's typically because the 50% is above this former resistance. All right, so just try it out, otherwise you don't need to. Okay, next is the scenario 3. Scenario 3 is you don't give a really crap about if it's this or that or origin or the prior high or low. It's just that it's in a spring, what we call an ABC. It's in an ABC spring. Bang. Sometimes it retests, sometimes it does this. Sometimes retest the C, right? But A, B, C, boom, or A, B, C, and then one more DE, we want to call DE, fine, and then goes. So this is scenario 3. So these are the 3 price-based pullback scenarios. The way you want to think about it is origin to, from here to there to scenario 3, which is the spring. All right, now here's scenario 4, is market goes back up here and it goes back down here, right? And here is a high volume area. This is a scenario. This is a scenario where it comes back over here and it's because this was a high volume area. That's all. All right, so I did. Scenario 1, scenario 2. Right? Now, there's no such thing as one being better than the other. The only thing is you developing the intuition about where the market can go. Having that intuition will allow you to get the pullbacks. I don't know why it's making gray. Stupid. Do this. All right. I don't know what I did here. Fill it up with white. All right. So the thing is, you want to develop that intuition. So the way you do that is by watching the pullback, and you know, 1 is this scenario 1, scenario 2, scenario 3, scenario 4, and you'll develop it. Why? Because when the 50% is above, you look for this and see if it reacts. Otherwise, it's going lower here. If it doesn't, look for a spring, right? Look for a spring, meaning first pullback doesn't go here or doesn't go here. What are we going to look for? Spring, as a potential, all right? As a potential area. So you have an understanding about where it's going to go, and marking the levels in advance, so you're very well prepared. All right, I'm done. This right here, folks, is golden. If you understand this, you will see where the market's going, and then really this is a part of trend trading, because in trend, the worst or the bad understanding of it is that, oh yeah, it's just higher highs, higher lows. That is much more than that. It's how to buy the pullback after a higher high, and how to exit, after getting in. So, and the final thing I'm going to say is all of this will be exposed to you if and when you start using the wave chart. The wave chart will give you a very good development. What the hell am I doing? Hate all this. Anyway, the wave chart, overlaying that, all right, overlay. Can you believe this? Overlaying the wave chart on your bar or candle chart will allow you to see and develop the intuition of where the market will go. Anyway, let's take some practical examples now. Where was I? All right, so here's a practical example of the wave chart. Right? Why can't I even move? All right, so we're going to take a look at this. All right, so I think this was today. You have the market, it breaks down. So you expect it's going to react in this area, right? Why? Because this low is lower than 50%. So the market should react up here, near the high bar, near the zone. All right? And it does. Here? Yeah, I think this was it. It reacts. It reacts. Then after that, it gets bought up and it breaks right through. As it breaks right through, what in your mind, what should be ringing? There should be a bell ringing telling you that this breakdown is no longer valid. It's no longer valid because the high before it has been taken out, which is what? It's a trend change. On this time frame, there is a trend change. Now that the trend has changed, we're going to look to get pullbacks. This is clearly a rally. How do you tell? Trend breakdown failed. Breakout is right here. How do you know? Because it breaks the bar, breaks the high with the big bar. The biggest is 21 bars and 28 green bars. So that's a breakout. Does it have fall through? It has fall through. Does it have even more fall through? It has more fall through. So now you're going to look for pullbacks. Now my intuition now is going to tell me where to look for the pullbacks. So scenario 1 is right here, the green or red bar, right there. It's going to come back down, but that's pretty cheap. Scenario 2 could be this area right here, this level. Scenario 3 is that it does a spring. Oh, no. That's scenario 3. Yeah, scenario 3 is that it does a spring, so be on guard for that. And scenario 4 is that it's going to hit this level right here. Around this level right here, I know how to target it because I'm using this chart below. So I realize that, it's right here, 70, so in that 77.22 area, that strong hands should step in. So having all these levels in mind, it may seem a lot, but it's literally easy as 1, 2, 3, 4. I look at this is 1, this is 2, 3 is your spring, and 4 is here. 1, 2, 3, 4. It just goes 1, 2, 3, possibly a spring, or 4 is going to hit this level and go. And now the other thing is, I'm not like so it's a very easy 1, 2, 3, 4. Like, okay, here, there, right? But the thing is, I'm not going to stupidly just buy the pullback. All right, that is not smart. What I'm going to do is I'm going to go to this lower time frame, let this thing react, come back down. As soon as it gets to this level, see the pressure. This pressure will be at 77.40. Is there buying pressure? If there's not, guess what? We're going lower. Around 77 or 76.88. That's where the pressure is going to come in. You'll see. That's where the buying pressure is going to come in. And when it does, then you execute your entry using an entry procedure. All right, what is your entry procedure after the buying pressure comes in? Just follow your entry procedure. You can buy the pullback near the low bar, or you can buy it in whatever it is. Right? I have my entry procedure, and I'm just going to execute that. People have different entry procedures. Some will wait for reversal, green bar, or with outside key reversal and all that. It doesn't really matter. What matters is first you get to the damn level and show evidence of the buying. If there's no evidence of buying, there's no point of executing any procedure. Once it's there, then game on. All right. So now I've showed you 1, 2, 1 spot, 2 spot, 3 spot, 4. Where to get the trade entry, right? All right. That's the lesson for today. Now, where was the trade here? This was this here. The selling failed. This is the selling here failed. The selling here failed, and this bar here basically broke the downtrend. This whole downtrend was broken by this wave. All right, so now we're in an uptrend on the hourly. As we are in the uptrend on the hourly, this pullback was the entry area, right? This pullback was the entry. If you can execute, get in, great. But that was the entry area to get in order to ride this move, higher. Now, here's the thing. Where is the intuition here When it comes to the target, there is intuition involved. How do you know where it's going to go? Look at this area. Is this not the high bar, which the extreme low is the buying, extreme high is the selling? It tapped right into that area. And right there, you saw the selling come in aggressively, right there. Why? Because there's sellers there. You will develop that intuition because it's the pivot high, the origin of the selling. So it goes to the origin of the selling, which is an excellent place to exit the position. This guy is basically sold, test, and went down until it got reclaimed where? Right here. You see? This is, where's the box? You see this? Right there, some may call it the zone, the order block, blah, blah, blah. That's either the last red bar, the first green bar, tap, retap, and goes. All right? So, nothing really more to say, but that's you want to develop the intuition by understanding these 4 scenarios, sequencing them, and waiting for them to play out. That's all I got. Thank you. Have a good night. Bye.